Hello. All right, we're going to do our chapter 6 lecture notes. And so what we've got in chapter 6, it's a fairly short chapter. It's only 4 pages. So I expect this video to be short like the last one. And then I may end up making a homework helper video as well. We'll just kind of see how things go. So chapter 6 is more about internal controls, but as it relates to inventory. So this whole chapter is focused on inventory, and so is chapter 7. And so the inventory chapters are talking about a merchandising business for the most part. So businesses that are buying things and then just reselling them to someone else. And when you take managerial accounting, if you have to take managerial accounting, we will focus almost exclusively on manufacturing businesses. But we're going to do merchandising businesses in this chapter. So as far as internal control procedures, there's a lot of important information as it relates to like inventory management and keeping your inventory safe. So the number one thing that employees steal from their employer is cash, because it's not traceable. But the second thing is inventory. And so inventory is pretty frequently an issue for theft. And so our employees can steal it, but so can our customers. And so we have to put internal control procedures in place to keep people from stealing inventory. So as an example, when I worked at Walmart, one of my cousins, I have a lot of shady cousins. We don't talk about it in this class, but in my day class, I'm like, you have shady cousins. And they're like, no. And I'm like, oh, okay. So, but one of my cousins got arrested for stealing radar detectors from Walmart while he worked there. And then he was selling them to people. So like a radar detector is in the sporting goods department, and it beeps when a police officer is near you, so you know to slow down. And so I don't even know if they still exist. I mean, this was like 20 years ago. But anyway, my cousin was like taking those and then selling them off to his friends and stuff. And the way he got caught was kind of through the inventory system. So at Walmart, like the system keeps track of how many items are on hand. And so what he was doing is he would go into the system and adjust the on hand, which was completely fine. I mean, we as employees of Walmart, I worked there too, would adjust on hands regularly. So he went in and so he like took 2 home with him. So he went in and adjusted the on hand, and he would have been fine, but he didn't work in sporting goods. He worked in electronics, and he was adjusting on hands of sporting goods items. And then the system like caught him adjusting on hands. And so they started watching him and finding out what he did. And so they can use cameras and all kinds of stuff, but the actual inventory management accounting records caught the theft. So internal control is super important to make sure that we keep all of our items safe. So one of the first topics that we talk about is perpetual inventory versus periodic. And I feel like this was supposed to be a blank, and maybe I accidentally filled it in and then hit save. But perpetual, the word perpetual means continual. So what I think of is my church back home. It's called Our Lady of Perpetual Help. And so Our Lady of Continual Help. And so as it relates to inventory, perpetual is talking about continually tracking our inventory. So always keeping track of how many items are on hand. So if I were a manager at Walmart, I could track the on hands all the time by just sitting in the back room. So let's say I'm the ketchup manager. There's not a ketchup manager, but let's say I'm the ketchup manager. I could sit in the back room of Walmart and I could see how many bottles of ketchup we have on hand. And as they go through the register, as people scan items, then the count would go down, down, down. And then at a certain level, it automatically reorders. And then if a shipment comes in, they'll scan the box and the on hand would go up, and we could watch it go up and down all the time. And that's called perpetual inventory. So that system of inventory is used in a lot of merchandising businesses, but not all merchandising businesses. So we can also have periodic. Now, in the periodic system, that means that you just every once in a while track what your balances are in inventory. So the only way to really know how many you have on hand is to walk out on the floor and count them. So as an example, like maybe an Ace Hardware, and maybe Ace Hardware does perpetual, but just as an example, if you think of like a little small mom and pop hardware store, as you buy, like if you go and you buy bolts, there's all the different sizes of bolts in individual bins. and you just like open up a drawer and you're like, I want 3 of this size and 4 of this size. And then you put them in a brown paper bag and you go to the front and you're like 3 at 25 cents and 4 at 18 cents. And then you buy the bolts that way. And they don't scan every individual bolt. And so if we wanted to know how many bolts we had of a certain size, we just have to open up the drawers and look. And so then at the end, so we know the way they actually keep track of inventory is they know what they have at the beginning of the year on January 1. They have an inventory count. And then all through the year, they just buy stuff, buy stuff, buy stuff, buy stuff. And at the end of the year, they count how many are left. And then they calculate how many are sold. So as an example, let's say we start the year with 150 bolts of a certain size. And then all through the year, we buy 1,000. So now we have 1,150 that we should have. Like we started with 150, we bought 1,000. So we have 1,150. If we go at the end of the year and we count and we only have, I don't know, 200 left, then we started with 150 and we bought 1,000. So that's 1,150. If we have 200 left, then we must have sold 950 bolts. And that's how you calculate the cost of the good you sold. So you figure out how many you sold by counting. The problem with that system is you can't track theft. So there's no theft tracking when you use a periodic system because you don't know how many you sold. So you don't know how many you should have. So my cousin that got in trouble, the reason why he got in trouble is because he was updating the on hands. If he didn't update the on hand, they would notice they were missing, but they wouldn't have known it was him. Okay. So they would have known, radar detectors keep going missing. We need to watch the radar detectors closer. But they wouldn't know why. They would just know that the system says I have 11 and I only have 9. 2 are missing. I don't know where they went. They must have been stolen. But in a periodic system, we would have no way to know that. We would just have to, we assume anything that's gone was sold. So, in a manufacturing system, we have 3 different kinds of inventory: raw material, work in process, and finished goods. Those 3 different kinds of inventory are all assets. This is pieces and parts. Like if I'm making bicycles, it would be like handlebars and tires and pedals and gears. And then work in process is partially completed items. So it'd be like if you looked at our factory floor, you'd see a bunch of bicycles that don't have the gears attached yet, but they're like almost done. But they're assets because we own them and eventually we'll sell them. Eventually we'll finish them and then we'll sell them. And then finished goods are all the completed bicycles we have that are waiting to be sold. So in a manufacturing environment, we have 3 different kinds of inventory. This blank is consignment. So consignment is another kind of inventory, and consignment inventory is when you are holding inventory that does not belong to you. Okay, so a good example would be, okay, so at one point I was going to sell my old crappy van. I had an old van and I didn't like it and I was ready to trade it in, but I wanted to get something else and I ended up getting something else, but I still had my old van and I didn't want it anymore. So my dad works at a car dealership, or he did. He worked at a car dealership. So I'm like, Dad, can you please like just park my van on your lot and sell it for me? And so if he said yes, he didn't. He was like, I don't want your crappy van on my lot. And I'm like, whatever. But if he said yes, then he would park the van on the lot and put, $2,000 on it. And then if he sold it, he'd give me the 2,000. So if he was counting the items in his inventory, if he was looking at all the cars on his lot, he'd be like, I have 87 cars. He would not include mine because my car is not his. He's holding it on consignment. If he didn't sell it, he'd just give it back to me. And so he doesn't own it. So that's the idea of consignment. So you might go to consignment sales. I know I used to go to them a ton when my kids were little and I would buy used clothes there. My friend Amy did consignment sales in Salina for clothes. So what I would do is I would price all of my kid clothes like a garage sale, but I would hang them and price them with a tag that had me identified on it. And then she would put them all on racks with 100 of other people, like 100 different people would bring a bunch of inventory to her, drop it all off with prices, and then customers would come in and buy it. And if she sold my items, she would keep 20% and give me 80%. So like if I had like a little baby kid pair of Gap jeans, I could say, I want $10 for them. In a garage sale, I'd get like $1. But in the consignment sale, I could sell them for like $10. And then she would keep 2 and I would get 8. And 8 is better than me having a garage sale. So that's the idea of consignment. All right, goods in transit, another topic. You probably want to draw something over here to the side. So let me just go out in Excel for a minute and draw you a picture. I don't think I can draw a picture in Excel. I need to draw a picture like with a, like, maybe I'm going to try it. Okay, I'm going to stop my share and reshare, but a whiteboard. Okay, so now you still see me, you see my whiteboard. And so the way that goods FOB shipping point and FOB destination point, that's where I was at, right? Goods in transit. When goods are on their way somewhere, you have to determine who owns them. So if we were to do this, we would start with the seller, and then we would draw another box and we would say buyer. Okay, so you guys can draw this like on your notes somewhere, but what we're going to do is we're looking at goods while they are on their way to the buyer. I wonder if I can. Okay, so while they are on their way, who owns the goods in transit? So while I'm trying to, like, so if I am the seller of goods and I sell goods, like I'm Amazon. Okay, I'm Amazon and I sell goods to Nicole. I'm the buyer, Nicole, Amazon is the seller. Who owns the goods while they're in transit? That's the question. So FOB, the first one listed is FOB destination. So if we look at FOB destination, FOB stands for free on board, and it just tells who owns the goods. So FOB destination means that the sale occurs at the destination. At the destination. So this is where the sale occurs. So at the actual destination point. And so that means that if the seller sells the goods while they are on their way, the seller owns them. So Amazon would own the goods until they got to my porch. That's called FOB destination. So if this date is December 30th and this date is January 3rd, on December 31, when they're on their way, the seller owns them still because the sale doesn't occur till it gets to the destination. So now we're going to do the exact same thing, and we're going to do FOB shipping point. So when we do FOB shipping point, again, we will have a seller and a buyer. And then as the goods are on their way, they are potentially owned by either the seller or the buyer. So basically, if it's shipping point, that means the sale occurs right there. And I'm good at drawing. I want to draw on the board, but I can't draw on the board because you guys are on the computer. So the sale occurs at the shipping point, not the destination. So if this is Amazon sending me goods, this is Nicole, this is Amazon, the sale occurs right here. And that means that if the sale occurs right here, then that means that all the way on the way, the buyer owns the goods. So on December 31, while they're on the way, the buyer owns the goods. And if something goes wrong, the buyer is responsible to figure it out because the sale occurred at the shipping point. So I'll come back to this concept later, but these pictures are a good thing for you to draw somewhere on your notes. And so hopefully you're able to figure that out. So, okay, next topic. So on the balance sheet and income statement as it relates to inventory, inventory is on the balance sheet as a current asset. So when you buy the inventory, you record it at cost. And then when you sell it, it becomes cost of goods sold. So when goods are sold, their cost is removed from inventory and reported on the income statement as an expense. So what we will do on our income statement. So before today, you guys did revenue minus expenses equals net income. That's it, right? So, oh wait, I think I had to stop my share Sorry, I think I messed up. I want to go back to my notes. And so now I need to share back to my computer. There we go. Okay, so back to my notes. So inventory is on the balance sheet as a current asset. When we buy them, we record them at cost. When they're sold, then they become an expense on the income statement. So on the income statement, in the good old days, we just did revenue, expenses, net income. In this chapter, we are now going to get fancy. We're going to get fancier. So we are still going to do revenue minus expenses as net income, but we're going to have several categories of expenses. And the first and most important expense will be called COGS. So we will do revenue minus COGS equals gross margin. I'm going to look and see if they call it gross margin or gross profit. You call it gross profit. Okay. I'm going to use the word gross margin and gross profit like kind of interchangeably. So here's where I'm at here. Okay. So gross margin or gross profit. So either word is fine. Okay. And so basically this tells you your markup. So if you sell a good for $10 and it cost you $4, then your profit on that transaction is $6. And then from there, we have other expenses. This is the cost of the good that was sold. But from there, we also have rent expense and wage expense and utility expense and all those things eventually to get you to net income. So when you're calculating COGS, you have your beginning inventory and then you buy stuff. And that gives you your goods available for sale. We call that COGS, but it has an A in it. So we call it COGS, C-O-G-A-S. And so if you sell the goods, then they're going to move to the expense on the income statement. But if you still own them, then they are assets. So these two formulas will help you with your homework a little bit. But if you think about the idea, whatever you start with, like so in our bolt example, we started with 150 bolts and then we bought 1,000 and then we had 200 left. So we sold 950 bolts. Okay, that's a periodic method. But with the perpetual method, we know what we sold. We know that we sold 950 bolts. So we would be like, all right, we started with 150, we bought 1,000, we sold 950. So we have 200 bolts left in ending inventory. And then if you go count the bolts and you only have 198, that means 2 bolts are missing. And in accounting, you call that shrinkage. It's theft. It's gone. The inventory's gone. So, okay. So as far as inventory control, I already talked about this. So let's move on to the next page. I'm on page 3 now. There's not a lot of blanks. I bet you guys are a little bit bored right now, and I'm sorry. Hopefully my questions are going to pop up and everything's going to be good. So when you sell goods, you sell them for whatever you decide to sell them for. So if I was selling this sweater, then I would be like, all right, I'm going to sell it for $29. And then the cost of the sweater, if I look at it, there's some buttons. It's just a pretty basic sweater. I don't know, $6. All right. So then the profit would be $23. And then from there, we would record our other expenses. But when we sell goods, sometimes customers return them. And if they return them, then that's going to be called a contra revenue. All right. So contra revenue. We've never had a contra revenue. We've had a contra asset, but we have never had a contra revenue. So a contra revenue is going to reduce our revenues. So they reduce our revenues. And the same thing would happen if we have so a revenue is a credit. So a contra revenue will be a debit. And then a sales discount is the same idea. A sales discount happens when our customers are given a discount for early payment. So a discount for early payment is usually quoted as like 210 net 30, 210 net 30. And what it means is you get a 2% discount if you pay the bill within 10 days. But if you don't, the net balance is due in 30. So what that means is if I'm a customer, so when I worked at that heating and air conditioning place, this happened a lot. I bought most of my supplies from Bedker Supplies. It was in Beloit. I lived in Concordia. I would buy the stuff from Bedker because what they would do is as long as I ordered by lunchtime, they would bring me the goods that afternoon. So I didn't have to wait like a day or 2 or 3 for shipping. I would just call through the day and say, I need this part, I need this part, I need this part. And as long as I called by noon, they would bring it to me by 1. So they left every day at like 12 and brought over my inventory for the day that I needed. And they did that every day. So if I ordered after 12, I would get it the next day by 12. And then I could say, I'm sorry, I can't fix your air conditioner. I'll get the part tomorrow afternoon and we'll be back. So when I did that, it was like I would order about $18,000 worth of stuff from them every month. And when I got the bill in the mail, it would say 210 net 30. I was a customer and I was like, oh, 210 net 30. What is that? Right. So what that meant was $18,000. A 2% discount would save me $360. So I could pay my bill in 10 days and save $360, or I could wait till 30 days and pay the whole balance. So I could either pay $18,000 and take a whole month to pay, or I could save myself $360 and only pay $17,640. And so really the difference is, do you want to pay in 10 days or do you want to take that extra 20 days to come up with the money? And so I would almost always take the discount as long as I could get my bill all tied out and processed and stuff, because 2% for 20 days of savings, if you annualize that, is a huge savings. And you will not earn, like if you kept your $18,000 in the bank and you earned, let's pretend you earned 5% of your bank account. You don't, but 5% is $900, but we're only talking about 20 days out of 365 on I equals PRT. So the most you can earn at 5% interest on that 18,000 is $49. And so I would rather save 360 than earn $49. So it's always a good idea to take a discount. So let's go ahead and let's do some journal entries. Okay. So our first journal entry says March 10th, Cloud Ceramics sold inventory costing $2,000 for $2,500. Terms 210 net 30. So it's March 10th. Oops, here we go. March 10th. And we are selling goods. Now, this is the first time I've sold goods with you guys. So when you sell goods, it says we sold inventory. And so we're selling it to the customer and they're going to pay later. We're going to receive the money later. So we're going to have accounts receivable, $2,500. These are the first journal entries we've done in this chapter. And this is revenue. So the revenue is $2,500, but I want you to notice that I also gave you $2,000. So the $2,000 is the cost of the good that I sold. So we are going to receive money, but the inventory left the building. The inventory is gone. So the other part of this entry is COGS and inventory. So the inventory left the building. The cost of the good that was sold is $2,000. We can see our markup, our gross margin is $2,500 less $2,000. But then on March 16th, we're going to go ahead and receive the money. The customer paid on March 16th, taking advantage of the discount. So we are going to receive cash. Notice I skipped a line. And we are receiving the money we've been waiting on. So they are taking the discount. I thought that I was going to receive $2,500. I thought I was going to receive $2,500, but in all actuality, they're going to take a discount. So $2,500, the terms are 210 in 30. So 0.02 is the discount. So they are going to take a discount of $50. So instead of giving me $2,500, they're going to give me $2,450. So what most students, and this is wrong, but most students just do this, and then that's it. They just do 2 rows, $2,450, $2,450. But if you do that, it still looks like we're waiting to receive another $50. And so if you send your customer a bill for that $50, they're going to be mad because they're like, you told me I could have a discount. You told me I could have a discount. So we need to eliminate the whole $2,500 because they're not going to give us any more money. We've received all of it. And that $50 difference needs to be a debit. So my debits and credits equal. And the name of the debit is sales discounts, a contra revenue. Okay. So, okay. So on the next page, what is net sales? And so net sales is sales minus your returns and discounts. So sales minus your discounts and returns. So if a customer returns stuff, it's no longer a sale. Also, if there's a discount involved, that reduces sales. That's called your net sales. And then the multi-step income statement. Back in the good old days, it was just revenue minus expenses as net income. But now we're going to start with net sales. We're going to start with net sales, and we're going to subtract out COGS to get our gross profit. And then we're going to subtract out all of our other expenses to get net income before taxes. So this is called net income before taxes. Net income before taxes. And then from there, we're going to subtract out taxes. It will be quoted as a rate, and that will give us net income. I want to show you guys that it's still revenue minus expenses is net income. This is an expense. Then we subtract this expense, and then we subtract out this expense to get net income. It's just a fancier version. It's subtotals. We subtotal here because this is actually one of the more important numbers. If you're a merchandising business, what's your markup like? We like to know what the markup is like. And then from here, we need to get net income before taxes because taxes is a percent of this number. Okay. So then the net income is still revenue minus expenses is net income. So down here, this is just an example company, and we see our net sales, COGS, gross profit minus our selling and admin expenses. We have some interest and losses and stuff to get to net income. So, all right. And so the gross profit percentage is just calculated as taking gross profit divided by net sales. So gross profit divided by net sales, and it will give you a number. So, okay, I will make a separate video that will help you to go over your homework, and I'll walk through that with you, and I hope you guys are doing well. Thank you.